This is the Business Lens, where we go beyond the headlines and make sense of the numbers shaping your money, your business, and Nigeria's economy. Good morning. My name is Divine Alex. Stay with me. Let's connect the headlines to your business, your money, and the economy. Now, let's start with the states because their budgets are getting much bigger. But the question is, where is all that money going? So, the 36 states and the FCT have increased their combined 2026 budgets by 47.5% from 27.22 trillion naira last year to 40.14 trillion naira. Now, here's the interesting bit. Capital spending has actually risen to 25.83 trillion naira, but its share of the total budget has fallen from 73.24% to 64.34%. So yes, there's more money in the budget, but proportionately less is going into capital projects. And for businesses, investors, and ordinary Nigerians, the real question on their mind is this: are bigger budgets translating into more development on the ground? That is the question that they need answers to. And speaking of where government money is going, our next story takes us straight into the cost of debt. Now, this number is really interesting because it deserves a second look. Between June 2023 and December 2025, Nigeria incurred 10.61 trillion naira in additional debt service costs, while spending 6.47 trillion naira, yes, 6.47 trillion naira on strategic infrastructure. Now, let's put it simply. For every 1 naira that is spent on strategic infrastructure, about 1.64 naira goes into this additional debt service cost, and the biggest culprit is naira depreciation, which accounted for 9.37 trillion naira of that additional cost on external debt, while higher interest rates added another 1.24 trillion naira. So government is not just borrowing money. The changing cost of that debt is taking up significant fiscal space. And that brings us neatly to the next question. If debt is expensive, how much more does government actually need to borrow? Well, according to the federal government, borrowing could actually have been much higher. The government says it borrowed 11.9 trillion naira between June 2023 and December 2025 to support spending. But Finance Minister Taiwo Edele says reforms created additional fiscal space that helped reduce the borrowing pressure. The reform scorecard puts incremental resources at 20.4 trillion naira, which includes the 15.8 trillion naira from subsidy savings and another 3.1 trillion naira from additional independent revenue. But government also had 30.64 trillion naira in incremental expenditure during the period. So the argument from government is pretty straightforward. So yes, we borrowed, but without the reforms, we may have had to borrow considerably more. And that is what they're arguing. And much of that additional money went into something every Nigerian can relate to: the costs of keeping people on the government payroll. This is taking us to the next one. Now, this gives us another way to look at those subsidy savings, right? The federal government says it spent 9.39 trillion naira between June 2023 and December 2025 for minimum wage increases, salary adjustments, and allowances for public workers. Now, compare that with the 5.4 trillion naira that accrued to the federal government from the 15.8 trillion naira mobilized through subsidy removal and FX reforms. And remember, government recorded 20.4 trillion naira in incremental resources, but its additional expenditure was much higher at 30.64 trillion naira. So perhaps the better question is not simply where did the subsidy savings go, because a lot of us have been asking what are they doing with these funds. It's what were those savings competing with? Is it wages? Is it debt service? Is it infrastructure? And a whole lot of other government obligations. And from Nigeria's domestic finances, let's zoom out to the continent, because Africa has another expensive problem: moving goods around. Now, you might think that the biggest headache for African trade is getting goods across the border. Apparently, that's only one part of the problem. Now, the World Bank is saying that about 60% of Africa's total trade costs come from problems within countries rather at the border itself. Now, let's think port logistics right now. We look at customs inefficiencies, fragmented transit systems, different regulations, and weak infrastructure. So even when tariffs come down and the border opens, the business can still spend a fortune actually moving the goods. And that's the real opportunity here. Africa doesn't just need easier borders, it needs better systems behind those borders. Because for businesses trying to trade across Africa, the continent, getting through customs may be just the beginning of the journey. And sometimes the expensive part starts after the gate opens. And talking about systems that are changing, Nigeria's insurance industry is also seeing the consequences of its own regulatory shakeup. Now, let's see what the NICOM has in play. Now, the insurance recapitalization exercise has entered another important phase, and NICOM is showing that the new capital requirements come with consequences. The regulator revoked Universal Insurance PLC's license effective August 14 after the company failed to meet the new minimum capital requirement for its non-life insurance business. Now, NICOM has appointed Ogbonna Chukwumerije as a receiver and provisional liquidator to take control of the company's affairs. Interestingly, Universal Insurance had announced a 7.128 billion naira recapitalization deal with FPNG Co-Invest Limited just days before the regulatory action. So while the recapitalization exercise is creating a stronger capital base for complaint insurers, Universal's case shows the other side of the reform. Companies that don't meet the threshold can be forced out. And that takes us from insurance regulation to a market where the numbers are moving on a completely different scale. Now, this is really big, right? This is really a big market number. Trading activity on the FMDQ exchange reached 426.51 trillion naira. Between January and July 2026, that's already about 63% of the entire 676.71 trillion naira recorded last year, 2025. And what's driving this? FX alone accounted for 143.34 trillion naira, while automobiles contributed another 126.35 trillion naira. Now, FX derivatives added 17.72 trillion naira. So there's, clearly a lot of activity in Nigeria's financial markets, particularly around foreign exchange and short-term government instruments. Now, the interesting question here is whether this huge turnover reflects deeper market liquidity, stronger investor participation, or simply more money moving around in response to changing rates and market conditions. And away from that, because while money is moving around in the financial markets, investors are also putting serious money directly into government bonds. Now, this gives us another way to look at this, right? The federal government went looking for money and investors showed up with 1.73 trillion naira in bids. And the DMO's August 17 bond auction, the government offered 1.10 trillion naira, but eventually allotted 1.56 trillion naira, the strongest demand for June. I think we had the strongest demand for June 2026, where we had the 2038 bond, which attracted 821.32 billion naira in bids. But here's what caught my attention. Bond yields are coming down. The marginal rate on the 2038 bond fell to 17.79% from 18.40% at the July auction. So investors are simply putting substantial money into government debts, even as the returns on those bonds are easing. Now, that tells us something about demand for Nigerian fixed income assets, but it also sets up our next story nicely because investors don't only lend to government, they also lend to companies. And one company that has been under the spotlight is Gereju Power. Now, I saw this report on one of the platforms. So Gereju Power may finally be putting its bond controversy behind it. The company has reportedly paid 6.03 billion naira owed to investors on on its 40.09 billion naira series, one senior unsecured bond, according to sources that are close to the matter cited by Nairametrics. Now, there's an important caveat. Gereju has not officially announced the payment, but it confirmed it would bring some relief to investors after weeks of uncertainty over the obligation. And this is bigger than just 6 billion naira. When a company delays a bond payment, investors start looking at its liquidity. They look at repayment capability, the repayment capacity, and ultimately its credibility. So the market will be watching for more confirmation, because in the bond market, trust is almost as important as the money itself. Now, speaking of investors, let's take a second look at their money. Let's close with what happened on the equities market. The NGX is still feeling the heat. Yes, it's still red. The all-share index fell 0.35% on Tuesday to 241,611 points, extending its losing streak to 6 consecutive sessions as investors continue taking profits after the market's earlier rally. Now, market capitalization dropped by about 544.5 billion naira to 155.97 trillion naira, with First Holdco and Fidelity Bank among the stocks weighing on the market. But here's the important context. Despite 6 straight losing sections, the NGX is still up 55.26% this year. So this doesn't necessarily look like investors abandoning Nigerian equities. No, it looks more like investors saying, oh, we've made some gains. Let's take a little money off the table. Let's take, some money away from this and maybe do 1 or 2 things with the money. But we were left with 37 losers against 22 gainers. The profit taking was pretty broad-based. This is what happened. Now, from government spending and debt to insurance reform, financial market activity, and the stock market, that's the business story that we are following today. And we'll discuss more after the break. My name is Divine Alex. Stay with us. You're welcome back. This is the Business Lens of Rapid Television. My name is Divine Alex. Now, we've taken a tour through Nigeria's fiscal position, the capital markets, and the wider business environments. And there is a very interesting contradiction sitting in the middle of all these numbers. On one hand, we have government that is dealing with rising debt service costs, higher wage obligations, and growing budgets, while states are allocating a smaller proportion of their budget to capital expenditure. On the other hand, we have investors that are still showing a strong appetite for Nigerian financial assets. We've seen 1.73 trillion naira in bids at the latest FGN bond auction, while FMDQ has recorded 426.51 trillion naira in market turnover in just 7 months. So is this a sign that confidence in Nigeria's financial markets is great, improving, or are investors simply responding to attractive yields and opportunities that they can lay hands on? And perhaps even more importantly, are the reforms actually creating productive economic capacity, or are we becoming better at financing the cost of running the economy? That is the conversation we are having with our guest. And I have with me on call Daniel Efa, who is a global business analyst. Good morning, Daniel.
Fine. It's good to be here.
Okay. Now I also have with me Dikaja, who is a senior financial analyst with Nairametrics, and I think he's going to be joining us much later. But right now, I'm going to be starting with you, Daniel. Now, I don't know if you saw when I talked about the headlines, and we've heard that the government's argument that reforms created additional fiscal space with 20.4 trillion naira in incremental resources, but we've also seen additional expenditure of 30.64 trillion naira. Now, from a macroeconomic perspective, are we genuinely seeing an improvement in Nigeria's fiscal position?
Yes, there is a change in the fiscal position. But then the question, are you saying in terms of positive impact or negative impact? That's where we now need to.
We have to look at both of them.
So positively, yes, because now we have enough fiscal space. What we had was subsidy basically stifling the fiscal conversation. However, I think using the word stifling might not be correct, because it is not like we stifled and there was no purpose for this stifling. It was simply an opportunity cost, right? Keeping energy prices down to drive down uh, prices in the local economy, or freeing up that subsidy payment so that government can have more money, and hope that the monies would in turn yield a lot of value for the citizens. So that is basically what we did, and it is just an opportunity cost of switching what we spent our money on. So now that we have more money, we are also still seeing rising debt, and that is basically what we are saying. That why do we still have rising debt when we freed up so much money from subsidy conversation? They're just not just subsidy now, even exchange rate conversations also. So every of those reforms affected pricing at different levels, right? So it's only normal for citizens to now start saying, okay, if you freed up that much money, I think it should reflect almost again, if not immediately. This is over 3 years we've had that conversation, and I think that is becoming old already. That's the benefit of what exactly has been done. You get so one of the sweetest ways of identifying whether truly government has more funds, because what we had before was year in year out we had government unable to implement its capital expenditure commitment. You were paying salaries, we were paying so much on salaries, we were paying so much on debt interest, on interest repayment. But we had the numbers when it comes to capital expenditure was appalling, right? So one would think that that would have been one of the biggest wins as soon as subsidy removal happened. And I can tell you there is hardly, let's assume that we focus solely on federal roads, for example, because federal pocket is where the money comes to first. And let's assume that was what we did. There's hardly any federal road in Nigeria that would not have been completed if that was basically what we did. And that alone would have created extra value for the economy in terms of infrastructural, in terms of logistics issues, which is usually one of the biggest issues of our food inflation numbers. We saw the numbers come out, and it's crazy in terms of how expensive food keeps getting for the average Nigerian who has been dealt a big hand in terms of the effects of the reform. So when you look at that, of course, government will come out to tell us that to justify the subnationals having more access to money, and they should be the one really pushing the narratives of how do we do more for our people. Yes, I agree with that aspect, but it's not holistic. You cannot completely put the responsibilities of that to the state government, because I think that it's always easier when the federal leads the way in terms of fiscal responsibility. It makes it easier for the states to follow suit. Yeah. So if the federal government is doing well in terms of its core duties, you would easily be able to see that this state is the problem. Let's assume, for example, let's use road, for example. Federal roads pass through every state in the country. And if, for example, every federal road is sorted in terms of quality, you would easily know this state is the problem, right? You would easily say that this particular state is doing well. I think I saw a video of someone coming out to say those states is the interchange from into those states is terrible, and it has been like that for years, right? So if, for example, the federal government has fixed that, it is easier to hold Edo State government responsible for the state roads that would link to that federal road. And that is the problem, and that is basically why the kind of system of government we run it makes it easier for the federal government to lead the way in terms of fiscal conversations and give direction that states would follow. It is not too. Our problem has never been too much money. Our problem has always been about how to properly manage the monies that we have. So even if you give us too much money, if all the major institutions, whether it is World Bank, and decide to say Nigeria will start having $50 billion again every year just because we like Nigeria. It's from these particular reforms so far. It has not proven that so much money will also improve the quality of lives of the Nigerian people.
Nigerians. Okay, now, if debt service and personnel costs continue taking up so much of that additional fiscal space, where exactly is the sustainable funding for long-term economic growth supposed to come from?
Well,
Daniel?
the government is saying that it has to increase taxes. It has to do more in terms of other sources, um, uh, make more money from crude and all those. However, I think that we also know that the country, the whole idea of a low tax collection in the first place is not a is not a lack of patriotism conversation. Rather, is a sentimental conversation.
Okay.
You hardly see a tax collection issue in an advanced country where resources is available for businesses to thrive, right? If I have to provide my power, if I have to provide possibly even if I have to maintain a car or a company vehicle more than required number of times because of bad roads and any other resources that helps me to push my business forward. If I have to provide all these things myself, the what's the word? The interest or the excitement to pay taxes will almost be zero, and that's the issue about taxes. It's a pure social exchange that is usually a function of what the government is doing for me to be able to say yes, I should do that. Go ahead.
So now let's bring this into the financial markets. We have investors submit 1.73 trillion naira in bids at the latest FGM bond auction, and the DMO eventually were able to allot 1.56 trillion naira. At the same time, we have the FMDQ recording 426.51 trillion naira in turnover between January and July. Does that tell us something about investors, or are investors becoming more confident in Nigerians' fixed income? Or are they simply saying at these yields, this is where the money makes sense? Which of them?
I think that investors are not patriotic. It's not a patriotic conversation. It's a profit conversation. I think that is basically what the investors are doing. They are simply looking for where the money is. The government has done a lot of reforms to free up its fiscal space. At the same time, it has also given itself a very serious task by the monetary tightening that the CBN has done, which means that we are attracting a lot of investors in terms of people who want to invest in our bonds, invest in our automobiles and all. It's a good one in terms of us having access to funds. But it is not extra work. It is not like we did extra work to achieve that. It is basically what happens anywhere in the world. Anywhere you see interest rates being increased astronomically, like we did, you are almost sure to see
a lot of investors.
Subscription. Yes. Particularly if that particular country has a very good rating in terms of it's been able to honor its debt obligations from time to time. You always see funds follow such. So it is a function of where funds follow rather than what the country is doing right. So it is simply just a monetary policy effect that is giving us access to that amount of subscription and cash. Yes.
Okay, so now this is the bigger concern. When government is able to attract this much capital, could that eventually make it harder or more expensive for private companies to raise money?
Yes, it is. It becomes it's more like a bidding war now. Government is giving you a 19%, 18% return. That means that for private businesses who carry more risk, in terms of in terms of holding up, in terms of liquidation and all, it carries more risk for an investor. So an investor will definitely want you to give him or her more returns to be able to buffer that risk exposure. So for private businesses that are in this space at the moment, except it is a developmental bank that is giving you access to funds or a grant or seed funding, you might find it very difficult to have access to cash, right? Except of course another opportunity is if your stock prices is rising, doing well in the market, you can probably leverage that to get access to funds. But then you on the default stage, you're already at a disadvantage because government is the biggest player in terms of the biggest or the most interesting offer on ground. So you are going to be beating that offer. You likely have to raise your own stake also so that you can get access to such funds. So for in terms of borrowing, borrowing is expensive for corporate businesses or individuals at the moment. It is easier to basically expect to make money from the market and use that to leverage rather than going into the debt market to try to raise funds.
Okay, now something else caught my attention in that particular bond auction. The marginal rate on the 2038 bond came down to 17.79% from
Yeah.
18.40% in July, even though investors still came with very strong demand. What is the market telling us when demand is strong but yields are falling?
And so it's a function of auction. So it is an auction thing. So
Okay.
the CBN or whatever the issuer, whether it is the DMO, when there is a subscription of a particular bond, right? What it gives them the leverage to say we can reduce the rate we are offering. It is only when these subscriptions are not much that you can increase the rate to attract more. But then when the subscriptions are very higher than what you're expecting, you can reduce your rates. And for investors, 17% is still good because for 2030 is in 5 years. And if you look at the trajectory, if inflation keeps dropping the way it is, there's a view that we might be around 14% in monetary policy rate by then, right? So for an investor, I would jump on a 2030 bond maturity based on the fact that rates would likely drop, right? And it is not a bad option at the end of the day.
Okay, now we have the combined budget of the 36 states and the FCT rising 47.5% to 40.14 trillion naira. But the share allotted was capital to the share allotted to capital expenditure has fallen from 73.24% to 64.34%. For me, this is one of the most important numbers in today's conversation anyway, because ultimately businesses, don't grow simply because government announced bigger budgets. They actually grow when there is power, roads, transport, infrastructure, security, and the rest of them. So now from your perspective, what should we be looking for in this state budget? They grow when there is power, like I said. So what should we be looking for to determine whether the additional spending will actually translate into economic growth?
I think for Nigeria, as far as Nigeria is concerned, I think I'm not too fixated on what budgeting says. I'm more about whether whatever was budgeted was implemented in the first place. I think that yes, we are seeing a lot. Whatever the data is saying that there is a marginal reduction in expenditures might not, because it is not very, very distinctive in terms of the numbers. What it shows more is that state governments are suddenly starting to pay more attention to capital expenditure a year before election, because the funds, they have access to funds like from late 2024 into 2025, they've been having higher allocations. So what suddenly is pushing the rise in higher capital expenditure? Because more than half of these current state governors are looking to come back for second terms, and you're suddenly saying everybody wants to spend, right? It's not even an issue when there is a spending. The issue is the effects as are these capital expenditures actually being implemented. I think that is where the real conversation is, because if you're spending so much and you're not seeing the effects because on the infrastructure itself, then there is a problem, right? I don't think we've ever lacked a year since I've been following Nigerian democracy, or you get that we've not been budgeting something for infrastructure. The only challenge is that they don't get done, right? So if they will get fixed, or roads created and all those infrastructure developments done, it would make sense, and it will whatever is in the papers as budgets, rather than just the announcement that we see.
Okay. Now, imagine that you are an investor looking at Nigeria today. What is the one fiscal indicator that you would watch most closely over the next 12 months?
It depends on what kind of investor I am.
Okay.
Depends on what kind of investor I am. If I'm an investor trying to create jobs, trying to set up shop in Nigeria, I think I would be looking at what infrastructure would directly affect my business. I would also look at the markets that I'll be selling the business to, right? Are they able to buy my products? Because what our policymakers don't understand is that whatever actions they take tends to affect the disposable income of the individuals and in the economy, and that is the actual power. If your people don't earn enough, you won't have enough taxes. For example, see our current tax reform. Puts about almost 75 to 80% of Nigerians under the tax bracket, because under the 800,000 tax bracket. So that means that imagine having a country of about 200 million people, and about maybe 30 million are able to pay tax, or 20 million are able to pay tax. That's already a disappointing conversation, right?
Yes,
That alone cannot even guarantee you. So that you are basically depending on your entire tax estimation on 20 million people, right? And for an economy that is almost 75% young people that I'm talking about over 18 that are capable of earning and making money. So that data already gives you as an investor a think through, and you are just looking at it. Okay, if I can't start on a physical level in terms of creating jobs, I think I should just go to the markets, look at whatever is happening with our stocks, look at whatever is happening with our fixed income, and just pitch my tent there. It's hoping or betting that the country will get it right soon enough.
Now, we've talked about debt, and we've also looked at bonds, equities, government spending, and reforms. But if you just take a step back from all these numbers, what is the biggest investment opportunity and the biggest risk that these numbers are actually pointing towards? Is Nigeria moving towards a deeper, maybe more sophisticated financial market with stronger confidence from the investors?
I think that our market is becoming sophisticated in terms of in comparison to the African standard. I think that we are more for 2026, for example, 2026, for example. I think that we are number one destination in terms of market participation, and it can only start from there. We just need to keep building in terms of deepening structures. I think that I'm seeing a lot from the NGS, for example, in terms of repricing models, required lot arrangements, more like trying to lobby more participation in terms of corporate level. Those are the things that would deepen it, right? Deepening in a market like that requires a lot of players, in fact, on a global level, right? That way, when we're talking about the markets in Nigeria, as in Africa, when we talk about the Cairo, when we talk about Johannesburg, we should also be able to say the NSC, the Nigerian Stock Exchange, is also part of that list because it starts the process, right? and it's only now the job now is now resting on the actual what's the word is now resting on the economic team in terms of from the ministers to anybody in charge, Ministry of Trade and all, to now start saying how can now that attention is on us, how can we play this well so that we can begin to see the real dividends of this attention you get in the local economy. But the market is usually the start of that. If there's a huge confidence in your market, you'll be able to retain funds. You'll be able to have access to more funds. You have more what's the word? More Nigerians that are abroad wanting to also invest in the same market. It begins to now create the ripple effect of what we are. The risk only that I see is that we don't make good use of this particular attention to build the economy properly. If we don't, we are just would have just missed out on something very, 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 very big in terms of pushing the economy to a to a large scale, competing with emerging economies like Brazil and co, that have already gotten it right in terms of trajectory towards actual development, not just growth on the surface level.
Okay, not just growth on a surface level. Now, if you had to give maybe an investor one market signal to look at for from now to the end of the year 2026, what would it be?
I think I'll give an investor to just anything that is coming from the government at the moment, invest in it. Because it's election year, a lot of uncertainties. But then one thing is almost sure is that the market will still be here, no matter what happens, no matter whoever is the president, whether it's still the current president that becomes that takes his second term, whatever happens, market will still be here. So pitch your tent properly, do your mid-term, short-term profit taking, but then you can still properly make your money when it comes to the market. However, if it's about you investing again on the ground in terms of local investing, you need to also focus more on services. Focus more on areas where the government has less tariffs on. So you can basically edge the low tariffs to the low infrastructure available. So, for example, if now that we have almost zero import duty on electric cars, for example, you can now be studying things towards the green energy. You get whether it is trying to establish factories for lithium batteries. Those opportunities are there because there is a government direction towards that conversation. So those are the things that you focus that any businesses, any investor should focus on in the short term in terms of leveraging what we have as a country.
At the moment. Okay. Now, is there any other thing that you want to add in the belts that we've discussed?
So I think that overall, I think overall we've wanted to get a scorecard from the government. The Minister of Finance has done that, even though he wasn't really giving us an entire picture. It was basically being like a politician trying to justify the numbers, even though we also understand the fact that most of these numbers were implemented before he even became the Minister of Finance. But then giving Nigerians the true figure gives you an idea of you actually evaluating yourself properly, and you are also giving yourself a challenge ahead that, okay, this is what we're trying to do, this is what we plan to do right going forward, so that the level of trust that you're giving us in terms of saying, okay, most subsidy, no problem, should be repaid back properly for the Nigerian people.
Okay, thank you so much, Daniel, for joining us on today's Business Lens.
Thank you for having me.
Thank you. And before we go, this is the amount of room that the government has in its finances to spend. This is taking us to the business word of the day, which is fiscal space. Now, this means that the amount of room that was created, the amount of room that government has in its finances to spend on new priorities without creating unsustainable debt or destabilizing the economy. This is a perfect explanation of some of the conversations that we had here. So Nigeria can increase revenue, save money from reforms, or even borrow. But if wages, debt service, and other obligations absorb almost everything, then the government's actual fiscal space remains limited. In simple terms, having more money coming in doesn't necessarily mean that you have more money available to spend. And that's where we'll leave it today on today's Business Lens. Now, from bigger government budgets to rising debt service costs, from 426 trillion naira in FMDQ, market activity to 1.73 trillion naira in demand for government bonds. One thing is clear: there is a lot of money moving through Nigeria's economy and financial markets. But the bigger question is what that money is ultimately producing. Are we building the productive capacity that will support stronger growth tomorrow? Or are we simply getting better at financing today's obligations? That's the conversation we'll continue to follow here on the Business Lens. My name is Divine Alex. Thank you so much for joining us. And of course, thank you for watching. See you on the next episode of the Business Lens. Bye for now.